Hi, this is Matt Aaron, Chief Investment Officer with Inman Wealth Advisors. Well, it's been a crazy few days here in the market. I'm sure you've seen the headlines by now related to Silicon Valley Bank. Signature Bank in New York is another one that the federal government actually had to step in and take over the bank. And there was a lot to unpack in this situation. First, just like what happened with these banks. Who's going to be at risk related to these financial institutions struggling. What is the short-term impact to you as an investor, and also what's the long-term impact for the economy and the stock market as a whole. So first of all, just kind of looking at this specific situation, thankfully the Federal Reserve and the Treasury came out on Sunday and said, hey, we're going to go ahead and guarantee all depositors. Now, everyone's very familiar with FDIC insurance. When you've got a bank account in your name or names of multiple individuals or beneficiaries, you're protected for up to $250,000 per beneficiary in that account under FDIC insurance. The problem is, in this situation, Silicon Valley Bank specifically, they did a lot of work with other institutions and corporations, specifically in Silicon Valley, some startup funds, venture capital funds that had money for payroll that they had deposited with the bank. So if the government did not step in and say, hey, we're going to go ahead and guarantee the deposits, there would have been significant downward pressure on the stock market, and we would have had significant ripples, not just in the financial sector, but in many other sectors across the economy as well. You've got companies that would have had to start laying people off because they couldn't pay them their payroll. And that just is a ripple effect on and on and on and on. So the government did what the government actually in this situation needed to do, and that was to step in and guarantee the depositors. Now, the people they did not guarantee, one, the senior management for the companies are gone, as they should be. This is a prime example of what not to do from a risk management perspective. And then second, you've also got the individual investors. So people that invested in these banks and financial institutions are going to lose money. And if there were bonds associated with these financial institutions, these banks, so they had put bonds out on the open market for fixed income positions, they're going to lose money as well. So the people that are going to be guaranteed are the people that in this situation really should be guaranteed, and that is just the folks that went to the bank to deposit money, even though their money was in excess of the FDIC insurance. So that's the situation for these banks. The question is now, what's the impact on the market? So when you think just kind of short term here, we started to see a run on other banks. There was another bank today that was down about 67%, I believe, on the day, and it's because there's worry that other banks also poorly manage the risk in their portfolios. So if you think about what was it these banks did incorrectly? There's a lot of fingers being pointed at the moment. It is a complicated situation, but in essence, banks are supposed to be fairly conservatively run institutions where they take in deposits and they loan money out, and hopefully they're making more money when they loan out or in their investment pool of assets than what they're giving to clients who deposit money. What's specifically, now I'm not as familiar with Signature Bank in New York, but specifically when you think about Silicon Valley Bank, they had long-dated bonds in their investment portfolio, mortgage-backed securities that had a duration of 10 years or more. As we all know, because we've been doing videos about this for a while now, as interest rates go up, the value of those bonds go down. They have an inverse relationship. So they had unrealized losses, significant unrealized losses on their bond portfolio. Well, when all of a sudden they had large withdrawals coming out of their bank, they had to dip into that bond portfolio and they had to realize those losses by selling those positions. So if they were able to hold those positions all the way till maturity, they would have gotten par value back for them, but they were significantly underwater and they had to go sell. So that leads to a difficult financial situation for the bank, and all of a sudden everybody knows it's a difficult financial situation for the bank, and then everybody runs to the bank to try to get their money out. Now, for the next few weeks, we probably will continue to see volatility specific to this situation, even though these two banking institutions are going to be taken over by the government, and they will figure out what to do with the assets of those banks and probably be sold to other financial institutions. there could be additional fallout. There could be other regional banks. Silicon Valley Bank was not a small bank. They're a top 20 bank in the United States. And so it is important that we kind of keep an eye on, what are the ripple effects in the financial world as it relates to other smaller banks and other banks who potentially didn't manage their risk very well. Long term, this is probably not going to be the sort of the straw that broke the camel's back, because the government stepped in and supported the depositors. If they had not stepped in, then we would have seen a much more significant run on banks, in my opinion. And really, everybody would have been going to the big four, as they say, to bank with them, because they would be too big to fail. So I do think that because the government stepped in and supported the depositors, that the impact will not be so significant that would be a repeat of 2008 and 2009, but there is going to be an impact. So imagine you're the president of a bank, and you've got deposits coming in, and all of a sudden you got nervous customers who are saying, "Hey, I'm going to take some cash out." Oftentimes, those nervous customers are going to have a good amount of cash that they want to take out. Well, as a bank, you're going to probably limit the amount of credit or amount of loans that you're making, because you're worried about what are my withdrawals going to look like. So for the next few months, it's very likely that the credit cycle kind of slows down a little bit here in the United States, and that will have an economic impact on GDP and the growth in our country. So we do think that there's going to probably slow down growth for the entire economy, but in the long term, we don't think it's going to be a significant impact. That's kind of twofold. There's multiple reasons for that. One, we were already worried about inflation anyway. Inflation was coming down. This will really probably put a damper on those inflation numbers. And next week, the market was priced in the Federal Reserve is going to increase rates by 0.25% or 25 basis points. It's now kind of a coin toss about, are they going to raise rates or not? Because them raising rates as quickly as they did is also what really hurt some of these financial institutions in the first place. So we'll have to kind of see, how we work our way out of this. But we actually still think that, by the end of 2023 and going into 2024, we can actually be in a pretty good spot from a stock market perspective. You take a look at the stock market, the S&P 500, the valuations don't look crazy. They actually look fairly reasonable. We still think it is possible that maybe we kind of retest some of those lows from last fall. But we're not seeing anything much more beyond that at this point. Obviously, it's still a situation that needs monitoring, but a little more anxious in the short term to see what that volatility is going to look like. But in the long term, we still think that things are looking up. If you have any questions, please don't hesitate to give us a phone call. Our phone number is the same as when it was Integrity Advisory, so feel free to give us a phone call or email us, and happy to have a conversation. Thank you.